Thanks for joining us for this episode. Today, we're joined by a friend and colleague, a fellow REMAX agent who specializes in assisting landlords. So we're similar as we are here to support you. However, we're also a bit different. Our landlord protection program was built to help the average Joe landlord, an investor who is just starting out with their investment journey, probably has somewhere between 1 and 6 properties, so that we can help guide and assist them through the entire purchasing process, as well as managing their single family to small multifamily properties. But when the time comes for an investor to up their game and expand their portfolio, Addy is the guy you want to connect with. As I mentioned, Addy Saeed is a fellow REMAX agent, but his specialties are geared towards investors who are looking for a different type of investment strategy. They concentrate on large multifamily properties and asset management and are geared towards helping mid-market investors. So today we're going to discuss these types of properties, and we'll also touch on investing with registered funds, and we're going to get into a webinar that Addy's going to be hosting in the middle of January. So without further ado, let's bring him in and let's welcome Mr. Addy Saeed to the show. How are you doing today?
I'm good. I'm good. Thanks for having me. It's a pleasure to be here, and thanks for that enthusiastic introduction. I can't remember the last time somebody introduced me like that, so I'm happy to be here.
Well, I'm not going to say that you paid me to say all those great things, but no. Lovely to have you. We're looking for a little bit of expertise in your side. So, no, it's always great to have a different side, different expertise coming in so we can help our landlords out there in Ontario. So, why don't we just start with, the difference simply between small multifamily and large multifamily, or the difference why you want to get into multifamily versus single properties. Let's talk about that, I guess.
Well, single family, as are a great place to start. As an investor that is starting their investment journey, single families are a great place to be. You buy your first home, there's no capital gains tax on it. So you're growing your net worth tax free. When you go to buy your second property, you maybe buy a second home or you buy a condo. But the problem is that when you keep buying single family homes are not an investment vehicle. So they're not designed for that. They don't cash flow based on the amount of money that you pay for them. So what you need to do is get more sophisticated and get into multifamily. And it doesn't have to be a big multifamily. You can start small, start with a triplex, start with a fourplex, get into sixplexes. CMHC has some great programs for novice investors even that are looking to buy something that are 5 or 6 units. You can get like the MLI program. You can go with a conventional CMHC loan and some great products for people to expand their horizons and get into multifamily.
One of the things we mentioned on another episode when I was talking with my RBC rep, one of the best things that I think about RBC is that they will give you a residential mortgage on a fiveplex. So up to 5 doors, they'll give you a mortgage with only 20% down instead of getting to that 30, 35%, maybe even 40% down that were sometimes needed to get into the larger multifamily. So that is a great way to get started. I agree with you. And the other thing is when you have rent coming in from just a single family, that's just one income stream. Once you have multiple units, whether it's 2, 3, 4, 5, you have other rents coming in. So in case Unit A isn't paying rent this month, you still have B and C that are helping with everything. Where if your tenant is not paying at 123 Main Street, you're covering the whole mortgage for 123 Main Street. So it's definitely a little bit harder to get into for sure because it costs more money generally, but it helps with you're spreading out with the risk factor with non-rent payments coming in. Wow, a little bit of a tongue twister there for me. Sorry, I didn't mean to cut you off. I just wanted to throw that in there when we were going.
No, it's a very valid point. Having multiple incomes of streams of income definitely diversifies your investment. So instead of having like 50% vacancy because you have one of the units in your duplex is empty, if you have 10 units, you have 10% vacancy, and it gives you time, and the property itself absorbs a lot of the hit from not having that unit rented. So very, very valid points. The other thing is, if you look at the smaller properties like single family homes and you compare the income that they generate with what the comparable value you have to pay for that property, there's a mismatch in the math. And you see this evident even today's market right now. You see a lot of investors that invested in condos and they were hoping for appreciation. So a lot of times the math that the investors were doing, again, it's a toss up right now if I want to call them investors or speculators. But the math that they were doing is that you're going to be able to put $400 or $500 a month into this project, but the property is going to appreciate in value, and that's how you're going to make your net return. So a lot of people got caught with that, and we see a glut of units right now in the market, especially in Toronto, condo units that are sitting on the market and are not moving. And I don't think they're going to move anytime soon either. We have an interest rate announcement that is coming up tomorrow, and I'm hoping that it's going to be 0.5%, but it's actually going to take some time for the condo units to normalize. We have so much inventory right now, and it's probably going to take anywhere between 6 months to a year for all of that inventory to dissipate, and for all this pent up demand to go through. If you're a buyer today, right now, an investor that is looking at picking up these properties 60, 70, 80 cents on a dollar, that's a great place to be. But not everybody out there has that capacity. And what they need to be doing is looking at fundamentals and picking up properties that have multiple units where the income supports the property. So it's not the other way around. It's not your active income that is going to support the property. It's the property's income that supports the property, and where truly passive income comes to life.
I like it. That's exactly what they need to be thinking about, right? Like when you're saying you don't have, well, it's true. Once you have the property taking care of itself, it's not reliant on you, right? It is actually even more of a business, right? It's now going through, and I say all the time that a rental property is like a business, whether it's single family or multifamily. But on a commercial loan, when you're looking at what the asset is actually going to produce when they're loaning against it, they don't really look at your personal situation at all. When you're buying a single family, they're looking at you being able to cover it, whether they're using 80% of the lease. Some companies will use 100% of the lease. Most are using 50% of that lease, and they're looking at your income to be able to cover that in case everything ever goes sideways. And sadly, with what's going on right now, there's a lot of rents not being paid, and a lot of smaller investors that are really getting stuck in a poor situation because of something they can't control, because the landlord and tenant board and RTA are completely in favor of tenants, and the whole system is completely flawed right now. Whether you're a tenant or a landlord, things should not take this long to resolve. It needs to get better for both sides. But yeah, there's no punishment, or not enough punishment, I'd say, for non-payment of rent. And how do we really get at that? So that is definitely something to be worried about when you're thinking about investing. It is more just about appreciation, right? We all see that our house is appreciated, your house is appreciated. People think, oh, let's just go buy another house and we'll rent it out to Frank and he'll pay our mortgage and that'll be our investment, retirement fund, whatever, down the road. Then all of a sudden something happens where they get stuck and that whole plan goes by the wayside because they didn't have that backup plan or that ability to do anything if something got tough. So having multiple units is definitely that is one of the main reasons to have multiple units, right? Is the diversification there of rent payments.
Yeah,
Um,
there is some light at the end of the tunnel. I know landlord and tenant board is something that we pick on a lot as an industry, but I did see an update that came through with from the landlord and tenant board and their L1 L2 applications, which are for non payment of rent. They're down to now 60 days. So it used to be 8 months before you were getting a hearing. They're down to 60 days. So they are making some good strides towards it. Their target date is around 25, which it's to be seen. Probably going to be another couple of months before we're going to start seeing some good progress there. But from 8 months coming down to 2 months, I say that they have made quite a bit of improvement in their processes. I don't remember the exact number of cases they have right now, but I'd just like to point out that they did make some progress, and I'm happy to see that progress. So the other thing you were talking about is appreciation, and as you just pointed out, rightfully so, appreciation is a calculation that everybody was taking into consideration anytime they're buying the single family homes, and that got a lot of people into trouble. A lot of people thought they would be able to assign these agreements and just walk away, but ended up having to close, but didn't have the capacity to close, and that's why we're in a situation that we're in.
I've used this example before, but if you have kids and you ever teach them how to wash their hands and they turn the hot water on too much, and then when you try to mix it in, they're turning the cold water on too much, and back and forth with the hot and the cold. I really think that's what the government has done with a little bit of what's going on here with interest rates and different things like that, where they're trying to control stuff. They open the floodgates and they close them too tight. And now I'm thinking that the next little bit, hopefully, they're not going to open them up too wide again when we do start to roll again. I also believe there's going to be a little bit of a rate drop announcement. They're saying quarter to half a point is going to be going on here. So I think the majority are leaning towards obviously hoping that there's going to be a half a point, but that seems to be what everybody is thinking as well.
Yeah.
So when you talk about asset management for your clients and everything like that, why don't you tell us a little bit about how you guys do that for everybody? What does that entail? What are you looking at there? Because we get a little bit of property management, right, where they don't have to worry about that. But what is the asset management side of it?
So basically, what we have, so I'm going to take a step back and try to explain why we have the asset management arm. So I'm a broker of 20 years. I specialize in multifamily, and I have a website called buildingsforsaletoronto.com where we post a lot of our exclusive and on market listings. So we were working with a lot of clients that were coming to us and saying, Addy, I have the capital to invest, but I don't have the time nor the resources to manage this building. Do you have a service available where you can manage the building and literally just give me a report on what's happening with the property? And that's where our asset management company came about. The company is called Westcliff Asset Management, and what we do is, and this is a deal. We just did a transaction this week. I literally just closed on it on the weekend, and we're basically taking over the management of it. And I reached out to you, Kevin, and you're providing me with a proposal where you're going to be doing the property management portion, and our job is to highlight and create a plan for that asset and make sure we achieve it. So when the client purchased it, they expect X% return on that property based on an IRR, X% IRR return on that investment. And our job is to make sure we hit that, if not surpass it. And property management is the daily, day to day. Asset management is more on how do we get the proper loan in place? How do we make sure that any money that we have sitting there is being optimized? So we're reinvesting that money into an investment vehicle that is still generating a return. Asset management is more about, hey, you know what? There is a basement space that is sitting here that is empty. We need to put a unit in here. What are the steps that we have to take in order to convert this space into a money making machine or a money making asset? Taking a look at your laundry agreement, taking a look at your roof, for example. One of the big things when I was working for institutional capital, one of the big things that we looked at is, hey, the building is 6 stories or 7 stories high. Do we have an antenna agreement? Is there revenue that is being generated from antennas on this property? And we would make sure that there's money coming in from every single aspect of the building. Parking is another one. How do you make sure that the parking is generating income? Those are the things an asset manager does. We basically take a look at the top line and we hold the property manager accountable to the expenses. So we make sure that these are the expenses that are for the property. We need to make sure that we stay within them. It doesn't mean that you're not going to spend money on the property. It just means that you're actually being thoughtful about the money that you're spending and making sure that any money that is being spent is generating a return for you.
Having a plan, being proactive instead of reactive, I think that's one of the best things that we can do with what we're involved in. And the other thing is having control, right? So when you're having somebody like yourself involved with everything like that, for somebody that wants to have more of a passive investment, because that's the one thing. I used to do a talk with an IG guy, an investors group guy, and we used to go back and forth about what was better, stocks or real estate, and the answer simply is real estate. We're the better investment. I'll put that down time and time again. But the one thing that he did beat me out on was you can get a stock for $10. Can't get into real estate for $10. And it was completely passive because it was being managed by your stockbroker or investment guy, right? This has got to be the same thing. That was one of the ideas that we thought about with the property management companies. How can we make this more passive or as passive as the investor wants it to be, right? Some want to be a little bit more hands-on than others, but at the end of the day, everybody wants that little bit of help, that team, that guidance, that um, professionalism around every single type of trade or connection that needs to be used in this venture. Um, the other thing that we wanted to touch on a little bit today is not more for landlords, but another way, because it's not really a landlord, but it is a way that you can invest in real estate. And again, not really a traditional way that a lot of people think about. Again, the beginning step is definitely residential, single family, right? That's how people get in. We've helped a lot of clients where they kept their first home when buying their second home. That seems to be, from what I've gathered, the easiest way to get into investing for a few different reasons. But anyways, that's for another show. What we want to talk about now is just that different type of investment strategy where you can use registered funds, whether that's RSPs or your TFSA. There's different ways to use those. I think the one that everybody heard about from years past or what's going on with syndicate mortgages and then how that kind of um, had its little turn and run through. But why don't you break down with what you guys do with TFSAs and registered funds as well?
Yeah, well, before I get into it, so one of the ethos that we run Westcliff at is based on learn, invest, and then manage. So learning is a big part of my life. My business partner in Westcliff, Kaz Joffer, shout out to Kaz, is probably going to be listening to this afterwards. We're lifelong learners. We're both the same age. We both come from similar backgrounds. Both of us grew up in a challenging area in Toronto before we went our different ways and met again. But the main idea is that we want to teach people about different ways that they can invest. You mentioned something about stocks. You know, you can buy a stock for $10 and it's low barrier to entry. There are options in real estate to invest the same way, where the barrier to entries are lower. So you can invest with as little as $5,000, and you can invest in two main assets when it comes to real estate. You can invest in equity or you can invest in debt. Debt is usually more secure, where you're investing in lending out money to another party who's real estate related. It's secured against real estate. Versus when you're investing in equity, you could be investing in an income producing asset, which is a little bit more fixed income gauge towards fixed income, or you could be investing in development, which are considered a riskier of the bunch because depending on which phase of development that you're investing in. Again, you can use registered funds for these depending on the actual investment vehicle that you're investing in. You can use your cash. And you can also use other registered accounts such as TFSAs and your first home accounts and RESPs. So there's different ways of investing into those vehicles, and the barrier to entry is low. But there are stipulations. You have to be either an accredited investor or an eligible investor. Accredited investor is somebody that makes over $200,000 a year. An eligible, as a person, as a single person, or as a family makes over, you and your spouse makes over $300,000 a year in annual income, then you can qualify for it. Or if you have more than $1 million in financial assets, so this means like you have RSPs, you have stock options that are more than $1 million. That's the creme of the creme, like the high risk investments, but they have the best returns as well. Compare that to other investments where you can be eligible, you can invest in those too, and the returns are actually much better than what you see in the marketplace. You could see returns anywhere between 8% going all the way up to 25, 30%. So the market is ripe for those, especially this time of the year when you have people that are looking at getting like maybe 6 to 8% on their existing RSP. They can actually switch over and invest in real estate, in active projects, and generate a much higher return than your average 6 to 8%.
So is that what the webinar in January is going to be about? What is that all about? What's happening in January?
Yeah, January 14th, 7 p.m. We're basically doing a webinar where we're talking about exactly this concept. It's explaining everybody how to invest money passively in real estate. You basically are investing with your equity. These investors, like I'll give an example. You know, if you take a look at any big building that has gone up, the developer over there, I can guarantee you, didn't invest all of their own money. They actually went out and raised money to build that building. And that money is raised from investors like your listeners here, like people like myself, who want to have a way of investing in real estate, but not having to do everything. You're basically investing your money, and your money is working for you, and it's generating a return for you while you're doing your own job. RSPs, like registered funds, are lazy money. What I mean by that is it's lazy capital that needs to sit in an account for a long period of time. You need to invest it in projects that are compounding more regularly and are able to leave more money behind for you. Instead of generating a return of like 6-8%, if you're generating a return of 12 to 14%, that your nest egg is going to grow much faster because it's going to compound much faster.
That's the math behind it for sure. Now, if I wanted to join on this webinar, would I go to heyaddy.com, or how would I find out about it?
Yeah, so anybody that is interested in joining the webinar, you can go to CAL. Actually, you know what? We'll put a link on westcliffam.com. You can join the webinar from there. You can also go to westcliff.com/invest. to learn more about investing in alternative investments. We also have a podcast called Smart Real Estate, and you can go and check that out at westcliffam.com/listen. Anybody that is interested in apartment buildings, we're more than happy to connect with them. You can reach out to us through our website, buildings for sale, with buildings with an S, for sale toronto.com, and happy to connect with anybody.
I will definitely make sure all that gets up on the podcast and on everything there, so people can see it or hear it or find it in the bio or whatever magical ways that gets posted up there. But if you can't find it and can't figure it out, you can always reach out to me, and I can definitely connect you with Addy as well. I think this was a nice packed full of information, a nice quick 20 minutes or so that I'm hoping shows people that there's a little bit more out there than just buying that single family or small multifamily, and other ways that we can do things. There's different ways that we can help. Again, whether it's myself or Addy, investing in real estate is definitely the best investment you can make. And multifamily is going to have a better return for you than single family every time, no matter what. So thanks so much, Addy. Thanks for joining us as well.
Thanks for having me, Kevin.
And we'll talk to you guys soon. Thanks so much. Bye for now.
Bye.
Please remember, while we are professionals, this podcast is for informational and entertainment purposes only. The advice shared may not apply to your unique situation. Always seek personalized advice from a qualified professional before making any investment decisions.
Hey, everybody. Thanks so much for joining us this week. I hope you enjoyed the episode. If you're finding it informative and useful, make sure to like, subscribe, share with a friend so that we can keep getting the information out there to Ontario landlords. And keep on joining us. We'll see you next time.